Welcome, future market giants. Are you ready to discover how to make money even when the market moves against you? Today we'll dive into the ones who control liquidity and have the power to push the price in any direction. We're talking about the market makers. So if you want to become a successful trader, it's absolutely crucial to understand how they operate and what sets them apart from regular traders. Market makers aren't just random people off the street. They are authorized participants of the market granted permissions to place both buy and sell orders at the same time. So their primary mission is to provide liquidity. Market makers constantly place buy and sell orders, ensuring there is always someone to trade with. And thanks to them, we can trade at any time of day without worrying that the market will freeze up. And the question is, how do they profit on the spread, which is the difference between the buy price and sell price? Buy cheaper, sell higher, and they are in the green. But market makers don't just throw orders around for fun. They have responsibilities to the exchange, maintaining a certain volume of orders, keeping the spread within the set limits, and being active for a defined period of time. Whenever you buy or sell an asset, market makers often become your counterparties. That means they buy from you when you sell, and they sell to you when you buy, keeping the balance between supply and demand. But what if there were no market makers? You would have to wait who knows how long until someone else decided to sell that stock. And when they finally did, you might end up paying a much higher price. The price would start swinging like crazy and trading would become chaotic. That's exactly why market makers are so vital for the market. Of course, market makers aren't involved in every single transaction. There are other players too, like speculators, hedgers, and so on, who trade among themselves. But in the end, many of these trades still flow back to the market makers once someone decided to close a position. Exchanges value market makers highly, offering them special privileges. In return, market makers provide the stability and liquidity that keeps the entire market running smoothly. So we can conclude that there are really two types of participants on the exchange: the traders and the market makers. As traders, we only have access to a very limited slice of market data. Market makers, on the other hand, see everything. The exchange gives them full access to all market data. They know exactly who wants to buy, who wants to sell, and at what price. It's like having a VIP access. They can see all outstanding limit orders, all outstanding stop orders, and even the open positions with entry price, trade size, and direction. But here's the key. Market makers don't act alone. They actually coordinate with one another to avoid conflicts and ensure they don't get in each other's way. Imagine you're a speculator. You come to the market and buy a single contract. Your counterparty will be market number one. Sometime later, you decide, that's it, I'm out, and sell that contract. But now the buyer is market maker number two. You walk away happy, flat, with no positions, while the market makers are left holding opposite trades. And the only way they can close those positions is by trading with each other. That means one of them will inevitably take a loss. This is why they work as a team, to make sure this situation don't turn into financial roulette against each other. Here's the catch. A market maker is like a huge ship, powerful but slow to maneuver. They are required to keep the market alive, always quoting price and often taking trades even when it's not particularly profitable for them. A trader, on the other hand, is more like a speedboat, agile, fast, and free. You can jump into the market or exit whenever you want, no obligations, no massive leftover positions, no need to maintain spreads, and that gives traders some serious advantages. First, flexibility. You can switch strategies daily, pick any asset, and only enter trades when it's good for you. Second is speed. In when you want, out when you want, no stuck positions. Third, profit potential. If you predict the direction correctly, the payoff can be huge. And of course, no obligations. Don't like the market today? Simply don't trade. In the end, market makers are always in the game, while traders only step in when it's profitable. And that's freedom. That's one of our biggest edges. So now you know a bit more about market makers. Of course, this knowledge alone won't make you an instant millionaire, but it will help you analyze the market more deeply and make smarter, more informed decisions.